Hi everyone and welcome to the Everyman Investor. So in today's presentation, I'll be looking at how we put together the final pieces in the jigsaw that is our equity portfolio. So I'll be looking at how to create a portfolio as well as how to diversify. So people often view the stock market as a stock market. What I view it as, however, is that it's a market for stocks. So to illustrate simply, so for example, if you go to a supermarket and you look at the shelves, no one ever walks into a supermarket and says that I'll take one of everything, which is basically what a lot of people think the stock market is about. So they buy an ETF that basically picks one of every stock that is available, but then you get the good, the bad, and the ugly together. Now, this might be a good option if you are not actively researching your own stocks, but for the best profits, it's probably best to pick the best in that market itself. So, for example, say you're on a budget, you head to the discount aisle of the supermarket, or if you are on a healthy lifestyle sort of initiative, you'll be buying a lot more fruits. Or if you're having a celebration barbecue, you might go to the meat section, or you might go to the wine section if you feel like having a good bottle of wine. So nobody ever walks into a supermarket buying everything. You always have something in mind that you want to buy, and it should probably be the same approach when you approach the market for stocks. Okay, so how does the market divide stocks? So there are various ways to divide stocks in the market. You can go by market cap, you can go by the industries, and you can go by the way they are used, which I'll introduce in a bit. So for market cap wise, small cap stocks are usually the most high risk stocks because these are usually small companies that are unprofitable or just barely profitable, and the market cap is usually less than $2 billion. The annualized returns are good, 15% over the history of small cap stocks and data that's been tracking the returns. Now, mid-cap stocks in general are medium-sized companies with a market cap of about $2 to $10 billion. These companies usually are mostly profitable, and they have got good annualized returns of 15.3% over the period that performance has been tracked. Now, large caps in general are the biggest businesses in the market, and these usually have got more than $10 billion market cap. The annualized returns are lower, which is not surprising because mature businesses in general do grow revenue slower than newer businesses. So it's often said that it's a lot easier to go from a 1 billion to a 2 billion market cap than it is to go from 100 billion to a 200 billion market cap, which, if you think about it, is true. To make 100 billion more is a lot more daunting than to make a billion more in terms of earnings, and which will be reflected in the market cap and the stock price rises. So for me, I actually view stocks in terms of what type of stock I'm buying. So there are hypergrowth stocks, which are stocks that grow fast but also come with a risk because these are usually unprofitable companies. There are growth stocks, which hypergrowth stocks can grow into, and these are stocks that basically grow on a consistent basis. There are income stocks, which basically pay high dividends, and there are value stocks, which took me a long time to understand actually. So as I mentioned, hypergrowth stocks are usually small, unprofitable companies with fast-growing revenue. Hopefully, the revenue grows faster than the business cost, and the inflection point for the company will be when it becomes profitable. It's a high-risk, high-reward play. So some of these companies will end up bankrupt, which means your stock becomes worthless. Some of these companies will become profitable and go on to become great companies, and your stock will soar. As I mentioned, growth companies are profitable companies with growing profits. Companies like Microsoft, Apple, companies like that. Income plays are usually high dividend stocks, but these companies usually have minimal capital gains for a simple reason that a high dividend payout reduces the amount that can be reinvested in the business. And this is usually very important for most businesses that are trying to grow fast. The most important thing about an income stock is that the payout must be sustainable. If the payout is not sustainable, then not only will you lose your dividend yield, if the company starts losing money, the stock value will drop as well. Now, value stocks are very simply just stocks that are undervalued by various metrics: price earnings, price to sales, whatever metric you want to use. It can be a hypergrowth stock, it can be a growth stock, it can be an income stock. So for value investors, they actually just look purely at the value of the stock and also how the company's profits are growing, and pick those stocks based on the valuations mostly. Now, a good example of a hypergrowth company would be Palantir Technologies, which I do not own. So if you look at the chart here, Palantir basically was trading about $6 in the last quarter of last year. and subsequently it traded as high as $20 in the third quarter of this year. So if you had invested in Palantir at $6 and you had sold off at $20, you have made back approximately 2.5 times what you put in. So what happened during this period for this hypergrowth company? So in Q1 of this year, Palantir reported its first profitable earnings quarter, and this saw a sharp rise in the stock price. However, as you can see, the stock price subsequently came down after that, mainly because people were worried whether Palantir will continue to be profitable, and also other aspects of the company's business, which I will discuss. So in the second quarter, Palantir reported a second profitable earnings report, which means to say that it demonstrated sustained profitability over 2 quarters, and that's when the stock price started to soar. Now, the stock price has come down since for a couple of reasons. Number one, probably profit taking. If you had bought at $6 and you can sell at $20, I would do it. Number two, Palantir is a data analytics company. So the data analysis part of this company claims to have AI embedded in all its platforms. This is somewhat controversial. Some people think that yes, Palantir is an AI company, hence the stock price should go up and it's worth whatever multiple the market wants to assign to it. Some people think that Palantir is not an AI company, and that is one of the reasons why I have not bought this stock, because I still do not understand what it does exactly, and also whether or not it is really AI. Now, for income stocks, I'll take a look at Energy Transfer. So as you can see, over the past 5 years, Energy Transfer stock has actually not moved much. In fact, if you bought it 5 years ago, you'll be down by 24.63%. So Energy Transfer basically is a midstream company. If you have bought it at its below its median PE ratio, you'll probably be doing okay in terms of no capital loss, and you'll be sitting on a dividend yield of 9.39%, which makes it a pretty decent dividend stock if you buy it at a fair price, or if you buy it when it's low. So in those cases, you might even get capital appreciation. Now, the thing about Energy Transfer, the reason why the stock price has remained somewhat range bound. So let's take a look at the finances. So in the last quarter, Energy Transfer reported an operating income of $1.8 billion, interest expense of $641 million, which means to say it's about 33% or thereabouts of its operating income. It paid a dividend of $974.33 million, which is about more than half of its operating income, and it ended up with cash of $219 million. So as you can see, about 90% of Energy Transfer's operating income is actually paid out in interest or in dividends, which leaves it only about 10% to reinvest in its business. Energy Transfer basically builds pipelines to transport oil and gas throughout the United States. So I suppose its investment cost will be low, just have to build more pipelines. But at the same time, there's many competitors in that market as well. So the most important thing for income stock is the payout ratio. So if you are not interested at all in any of the financials, and you just want to go the fast way, the payout ratio for Energy Transfer, which you can get on any search, is 92.29%, which means to say it's not overpaying. It is keeping somewhere in the region of 8% of whatever it's earning for whatever money it needs to spend. I would not recommend buying an income stock based on just payout ratio, simply because payout ratio changes year to year. So it's probably a very, very good idea to go into the details of the financials itself before you buy an income stock. Now, the market also is divided into various sectors. So there's healthcare, there's materials, there's energy, there's consumer discretionary, there's consumer staples, industrials, utilities, financials, information technology, communication services, as well as real estate. Now, among these market sectors, a couple of them, actually 3 of them, are considered to be defensive sectors, which usually do very well in a market downturn or in an economy downturn. So the 3 sectors will be healthcare, utilities, and consumer staples. For a simple reason, no matter how poor the country is, you still need healthcare, you still need your electricity and water running, and you still need to buy food and drinks for yourself. So my portfolio is built on the 80-20 principle. So for me, I'm conservative in terms of my risk, and I basically make sure that at least 80% of my portfolio is in companies that are profitable and that have earnings growth, and 20% or less are unprofitable with revenue growth that is hopefully going to outpace their expense growth and hence become profitable and end up in the 80% that are profitable. So this is going to be my portfolio that I will review to you. Now, I will not share my whole portfolio for the simple reason I have reviewed certain stocks that I own already. I do not make any buy recommendations. My reasons being that everybody has got different risk appetite. Everybody has got different ideas as to what investments are good in terms of market sectors. Everybody has got their own ideas as to what companies will do best. So what I'm sharing is my experience, my mistakes that I made, lessons that I've learned, and things like that. My presentation is not meant for me to tell you what to buy so that you will boost the profits that I get from whatever stocks I own at the moment in time. So, but at the same time, I will share with you the industries that my portfolio is centered on, and basically my portfolio covers all the sectors in the market from just 13 different stocks that I own. Okay, so Berkshire Hathaway is a company that I own. Everybody knows that by now, if you're watching my videos. It is basically a one-stock ETF. Berkshire owns so many businesses and has got a stake in so many others that it basically owns every sector in the market. Now, Microsoft is another company that I've mentioned that I own. It's an IT service company as well as involved in communication services. Nvidia is a pure IT play. Fortinet and Palo Alto are both cyber security companies which basically involved in the IT sector. Now, the next part is the most important part when you pick a company. You must know the risk that the company faces in its business growth. If you find a company and you cannot find risks attached to that company, please, I would advise not to buy that company because there is no perfect company in the world. Only by knowing the risk will you know how much you can afford to take risk on that company and how much you should buy into in terms of the valuation multiples. So Berkshire, for example, even a company like that has got risk. And the risk is basically, the major risk factor will be succession planning. So Buffett is, by widespread acknowledgement, one of the best investors ever, but he is nearing 100 years old, and if anything happens to him, it will not be surprising. The question is whether or not his successors will be able to replicate his success in picking companies for Berkshire to buy and own. Now, that's not to say that Berkshire currently has got 100% success rate. So if you've been following the market recently, Berkshire has been dumping shares of HP at a loss. So no portfolio is perfect. Every portfolio has got profits and losses. The idea is that your profits are much more than your losses, and you know when to cut your losses, which I have already covered in a previous video. Now for Microsoft, the IT industry is very, very competitive. There are so many IT startups, so many mega companies in IT. So basically, Microsoft needs to continue to innovate, and to continue innovation is critical to its continued revenue growth and earnings growth. Nvidia has got problems with its stock from a valuation perspective. It is extremely overvalued at the moment in time, and the semiconductor industry is highly competitive. So Nvidia has got the most expensive chips, the best performing chips, but the wait times are 1 to 2 years for Nvidia's chips at the moment in time. Now, if you're a CEO of a company who wanted to expand its IT services or its data center services, would you be willing to buy a chip from an alternative supplier which performs 80% of what Nvidia's chip performs at a 50% price cut from what Nvidia is selling its chip at, and you can get the chip in 3 months' time? I would say, as a CEO of a company, I would be happy to buy the alternative. Now, there are companies with competitive chips in the market nowadays. You just have to try and find them. None of them are up to Nvidia standards, but many of them have got good performance as well. Now, for Fortinet and Palo Alto, the main issues are R&D. So the cybersecurity space is a continually evolving space. The bad actors will always find ways to try and break down the current cybersecurity. So if your product does not block the bad actors, you will lose market share. And this is why R&D is critical for both of these cybersecurity companies. Okay, as for the rest of my portfolio, I will share with you the remaining 8 stocks in terms of the sectors that they belong to. So the first company belongs to the information technology and industrial sector. It is a semiconductor company, and it produces semiconductors that are important in ITs and as well as various businesses related to IT. The second company is an information technology, utilities and energy company, which seems rather odd. But this company basically provides software and storage solutions to the whole grid basically. So it has got its software and energy storage solutions installed in various solar farms, and from there it basically manages the grid with its AI software and optimizes the use of energy in the energy grid itself, which basically exposes it to the utilities. The third company is even more interesting. It's involved in 4 different sectors: materials, energy, communication services, and healthcare. Now, the reason for this is that this is a specialty materials company, and it makes the raw material to make solar panels. It also makes products that are involved in communications infrastructure, and it makes a particular product that is necessary for valves in vaccines for healthcare. So the next company will be a healthcare company. This is a diversified healthcare business. It does not make drugs. It basically runs clinics, runs elder care centers, is involved in the healthcare insurance sector, and also runs pharmacies. There is a materials and energy company. This company produces materials that are essential for EVs as well as for various renewable energy facilities. I also own a company that is involved in consumer discretionary and consumer staples, and another company in the materials and energy sector. Again, it makes materials that are essential for EVs as well as for energy storage. The last company which I own, which is a particular favorite of mine, is involved in IT, involved in industrials, and involved in energy. So this company is very interesting. This company makes a product that's essential in the production of semiconductors. In fact, semiconductor factories have actually signed agreements for this company to build mini factories in close proximity so that they can supply this product to these semiconductor manufacturers. This company is also utilizing on its existing business experience to expand into the renewable energy space, and it has made huge investments in that area. So what are the risks involved in all these companies? Well, the first company has got a roadmap for its growth, and it needs to execute to perfection. Happily, its stock price is not, as per Nvidia's stock price, is not priced to perfection. It is priced rather reasonably. In fact, its price, I would say, is undervalued. But as we all know, all roadmaps do not end up with 100% perfect execution. The second company is currently unprofitable. It has got growing margins, profit margins, and I think it will become profitable in the next 1-2 years without becoming bankrupt first. So this is one of the 2 unprofitable companies that I own. The third company has got products that demand fluctuates depending on how the economy is going. So for example, if you have no money, you will not be spending your money on solar panels, which will affect its raw materials business. Similarly, if the government is facing a recession, it might not want to roll out its 5G network that fast, and this company's communications infrastructure service materials will suffer. For the healthcare company, if the US nationalizes healthcare, this company's profit margins will definitely be affected. For the materials and energy company, commodity prices are critical for its profits. It is not doing so well recently in the market because the commodity that it produces has not been doing so well in terms of its price. In fact, its price has been dropping quite significantly. For the consumer discretionary and consumer staples company, the discretionary part is highly dependent on consumer spending. So again, the economy is critical for its continued growth. Happily, the staples part is probably a good defensive play in an economic downturn. And for the other materials and energy company is the unprofitable company, the second one that I own, and again it is highly affected by commodity prices, plus its cash burn is extremely worrying at the moment in time, which is why I haven't added to it despite its price coming down significantly. Given that, I would say that the Infrastructure Reduction Act or the Inflation Reduction Act, whichever you want to call it, does let the company borrow from the government at highly favorable rates. So I would say that if this company executes like what its management says it will, it should turn the corner in about 1.5 to 2 years' time. In fact, by the end of this year, it is slated to start producing rather profitable materials. Now, the last company, like I said, has got a large investment in renewable energies. Its current business is fantastic by itself, but to grow, it needs to invest in something else, and it is highly invested in renewable energy. I do think that renewable energy will take off for the simple reason we either do that or we burn. as the record temperatures over the past couple of months have showed us. So, regarding diversification, okay, I think that diversification for the sake of diversification makes no sense. While ETFs have a role to play in your strategy for your own portfolio, it is more profitable to pick good individual stocks. That said, I do own what I would consider to be a tech ETF in terms of Microsoft and whatever ETF in terms of Berkshire. So yes, they do have a role to play, but do not diversify into every sector just for the sake of it. I would say it's probably best to diversify within the market sector, the investment trend that is the most likely to grow its earnings and its demand. So among the market trends and investment trends that I've identified, one is renewable energy. I've got 5 stocks, either directly or indirectly related to renewable energy. This is an area where I think that as the globe warms up and the younger generation sees how it affects them and their future, it will be something that governments will have to commit to in order to get elected. Then there's AI, cloud, and 5G, and I've got stocks that are either directly or indirectly related or exposed to these industries, which are unstoppable at the moment in time. I've got 3 stocks in defensive sectors. One of them is Berkshire. The second one is the consumer discretionary and consumer staples stock. And the third one is the diversified healthcare stock, which I actually bought recently in the September downturn. Among my 13 stocks that I own, I actually bought 3 full positions in the recent downturn, which shows that if you are patient enough, you can get stocks at reasonable valuations. All 3 are in the green at the moment in time. And to be perfectly honest, I have not touched the majority of the other 10 companies since October last year because as the market rallied, the valuations have been rather stretched. I would love to buy the industrial stock that is involved in renewable energy transition. I would like to buy more of it, but its valuation at the moment does not make it a compelling buy for me. So I would say it's important to plan your portfolio well in terms of what sectors you want to invest in or what investment trends you want to invest in. Decide on your risk appetite in terms of how much of your portfolio you want it to be profitable and how much you want it to be hyper growth but unprofitable. And also buy your ETFs selectively. SPY is probably the most bought ETF and it is not a bad ETF to buy. But at the same time, there are other ETFs that focus on various sectors, which I think will be better than just buying the SPY in general. That said, there's probably a lot more volatility in those sector-focused ETFs. So, thank you for watching. I hope this video was useful, and I will see you in my next video, which I will be talking about insider trading and how it can affect our views on a potential buy in terms of a stock that we're looking at, or whether or not we should possibly be thinking about selling a stock that we already currently own. So thank you very much, and I hope to see you in my next video.